Hi everyone and welcome to Next Generation Business School. We are here to inspire and equip the business and finance leaders of tomorrow. In this channel, we explore the depths of accounting, management, financial strategies, business tactics, and economic theories as much as we can. So please join us as we uncover the best strategies to help you thrive in your studies and also in your future careers. Please make sure to like, comment, and subscribe for more valuable content in the future. Let's build your future with the power of knowledge and try to success. Your transformation starts here. Let's start together. Okay, today we want to focus on accounting basics, the basis for business decisions and information for decision making. To start our video in this class, we need to focus on the meaning of accounting basics. So we will lay the foundation of understanding of accounting and its important roles in making informed business decisions. Whether you are business owners or students or someone interested in the world of finance, mastering accounting basics is very essential for success. In fact, we need to understand the concepts of accounting and its basic roles. First, start with accounting basics. So accounting is a systematic process of recording, summarizing, and analyzing financial transactions of business. So three important concepts and elements of definition of accounting is recording, summarizing, and analyzing of financial transaction of the business. And the primary purpose of accounting is to provide financial information that is useful for making economic decisions. So, our important aim in accounting is provide information for decision making in the business, because in our business we need to make day-to-day activity, and all of this day-to-day activity needs informations, and this information come from accounting activities. But first of all, what key principle exists to provide these important informations? The first important principles is accrual and cash basis. In fact, we need to understand the differences between recording transactions when they occurred in the accrual basis versus when a cash is exchanged on the cash basis. So, in the accrual basis, we need to focus and record the transaction just when it is occurred, irrespective of cash is exchanged or not. But in the cash basis, we consider the transaction just when the cash exchanged. The next important principle of accounting is double entry principle. Every financial transaction affects at least two accounts, ensuring that the accounting equations, that is assets equal liability plus equity, always remain balanced. So in the double entry systems, we want to ensure that the main basic accounting principle, assets equal liability plus equity, always remain in balance. In the next lectures and sessions, we analyze these important principles together through the practical examples in detail. The next important part of accounting basics includes financial statements. Generally, we have three main important financial statements in accounting, and these statements include balance sheet, where we provide a snapshot of the company's financial position at the specific point in time. Next include income statement that shows the company performance over a period, detailing revenues and expenses to determine profit or loss. And the final important statements is cash flow statements that reports cash inflow and outflows, highlighting how cash is generated and used in operating, investing, and financing activities. In fact, in cash flow statement, we divide the activities in business to three main categories. First, operating, next, investing, and third is financing activities. And reports cash inflows and outflows that highlighting how cash is generated and used through these three important major activities. Again, we will analyze and explain these concepts in the next sessions with together through the practical examples. And don't worry, we will understand every concepts in practice and example. The next part for today sessions is the basic for business decisions. First of all, for any business, we need to make informed decision making. In fact, accurate and timely financial information is crucial for making strategic business decisions such as budgeting, investing, and managing the resources. And financial data helps stakeholders, including managers, investors, and creditors, to assess the company financial health and future prospects. For example, in the investing decision, we need to determine where to allocate resources for maximizing the returns. In financing decision, we need to choose between debts and equity financing to fund operations. And in operating decision, we need to managing day-to-day activities to ensure efficiency and profitability. So the key point is make informed decisions in three important activities: investing activity, financing activity, and operation activities. And the next part is information for decision making. In fact, we need to make decisions in two important categories of financial information types of data. First of all, we need to focus on quantitative data, where numerical data such as sales figures, costs, and profits margins exist. And the other categories is qualitative data that includes non-numerical information such as market trends, customer satisfactions, and employee performance. In fact, in the accounting, we dealing with two types of financial information: qualitative and quantitative. In quantitative data, we're dealing with numerical data. In qualitative data, we express the data in non-numerical way. For example, market trends, customer satisfactions, employee attitudes, and so on. Who are the users of financial information under the information for decision making in accounting? In the one general basis, the users of financial informations divide to main two categories. First is internal users. That includes managers and employees who use the information to plan and control the operations. And the next categories are external users. That includes investors, creditors, regulators, and others who use the information to make informed decisions about the company. And the important next part is relevance and reliability of information. In fact, information must be relevant to decision making, that needs of users and reliables, that providing an accurate and fair representations of the company financial situation. So information needs to be relevant and reliable to successful information for decision making. In summary, by understanding the basis of accounting, you will gain valuable insights into how business operates and make decisions. This knowledge is fundamental for anyone involved in the business, finance, or management. And in our upcoming videos, we will delve deeper into each of these concepts, providing practical examples and exercises to help you master in accounting and the concepts that I explained to you right now in general mode. So again, thank you for joining me in this journey to understand the essential principles of accounting. And please make sure to subscribe and hit the notification bell so you don't miss any of our future lessons. Let's get started on the path of making informed and effective business decisions through accounting. Now, we are going to explore how accounting links decision making and economic activities with together. In fact, we want to know how accounting links decision makers with economic activities and the result of their decisions. We will break down these concepts using the simple diagram. Let's dive in. First of all, we need to understand this diagram. The diagram illustrates the continuous loop that connect the economic activities in the first steps at the left with accounting process, accounting decision, accounting information, and decision makers. So in this loop, we want to connect, as you can see through this way, accounting activities to accounting process, accounting informations, and decision makers. So what is the economic activities that include or first step in this loop? The economic activity are day-to-day transactions and operation of the business. For example, it includes sales, purchases, investments, and expenses. And all of these activities generate data that need to be captured and analyzed. The next activities that we want to focus in this loop is the accounting process. In fact, the accounting process is the systematic procedure of recording, classifying, summarizing, and interpreting financial transactions. And it begins with the collection raw data from the economic activities and ends with the preparation of financial statements. So economic activity take place in the first steps and feed the accounting process with recording, classifying, summarizing, and interpreting. Three important activities that start with the recording. And the accounting process is finished by preparation of financial statements. So this process finish by preparation of the financial statements and feed the next elements of these loops, that is accounting information. The process of the data in accounting informations is from accounting process that is transformed into useful financial informations. And this includes financial statements like income statements, balance sheet, and cash flow statements, and is crucial for assessing the financial health and performance of business. Decision makers rely on this accounting informations, and this accounting information is crucial for assessing the financial health and performance of the business. The final elements number 3 of these loops, is decision makers. Decision makers are the individual or groups who use the accounting information to make the informed decision, and they can be internal users like managers and employees, or external users of information like investors, creditors, and regulators. Decision makers rely on accurate and timely accounting information to plan, control, and make the strategic decisions for the business. So, the decision made based on accounting information impact the future economic activities. For example, deciding to invest in an equipment, launch a new products, or cut costs. And this create a continuous loop where economic activities feed into accounting process, producing information that guided decision makers, which in turn influence the future economic activities. The importance of accounting in decision making is that accounting always serves as a bridge between economic activities and the decisions through these loops. So, accounting is bridge these two activities, economic activities and decision maker with together, that take place through these loops and shape the business futures. And accurate accounting information allows business decision makers to evaluate performance, assess how well the business is performing financially, plan strategically, make informed decisions about the future investments, expansion, and other strategic moves, manage resources, allocate resources efficiency to maximize profitability and sustainability, and ensure accountability that maintain transparency and accountability, which build trust with stakeholders. Generally, understanding the cycles is fundamental to mastering the accounting, and it highlights the importance of accurate financial records and how they play a crucial role in business decision making. In these upcoming videos, we want to delve deeper into each element of these cycles and providing practical examples and exercise to help you apply these concepts in real world scenarios. In the next step, we want to going to explore the three main types of financial informations: financial informations, management accounting, and tax accounting informations. Understanding these categories is crucial for everyone looking to grasp the full scope of accounting and its implications. So let's start with the financial accounting. What is the financial accounting generally? Financial accounting refers to the information that describe the financial resources, obligations, and activities of an economic entity, which can be an organization or individuals. The main purpose in financial information is financial accounting to assist investors and creditors in making informed decisions about where to allocate their scarce investment resources. So, the main important stakeholders in financial information are investors and creditors. And the accounting information in the type of financial informations direct these two groups to allocate their resources efficiently. The key element for financial informations is involves the preparation of financial statements such as income statements, balance sheet, and cash flow statements. And the information is designed for external users. As you know, the investors and creditors generally includes the external users. For example, imagine you are an investor and you are looking to buy share in a company, so you would examine the company financial statements to understand the profitability, financial stability, and cash flow situation before making your investment decisions. The next type of information is management accounting informations. In fact, management or managerial accounting involves the development and interpretations of accounting informations intended specifically to assist management in the operation of the business. The main objective is provide relevant information to managers and employees to help run and control daily business operation effectively. So the main stakeholders in the management informations or managerial accounting are managers, as you can see, namely, and also employers. And these two stakeholders are internal stakeholders of business. This type of accounting informations is often financial in nature, but it is organized in a manner that relates directly to specific management decisions, such as budgeting, forecasting, and performance analysis. And management accounting information is intended for internal users, as I explained to you, and primarily managers and employees within their organizations. For example, consider a company planning to launch a new products, and management accounting would provide detailed cost analysis, sales forecasts, and budget projection to help managers decide whether the product launch is feasible and how to allocate resources effectively. The next type of accounting is tax accounting. In tax accounting, we witnessed a specialized field within the accounting that focuses on the preparation of income tax return and tax planning strategies. The main purpose of this type of accounting is to ensure compliance with tax. As you can know, the main purpose here is compliance with tax laws. While we need to optimizing the tax liabilities through the effective planning also. And this involves calculating the taxable income, filing tax returns, and developing tax strategies to minimize tax payments legally. Tax accounting information is used by both internal and external parties and includes the company management, tax authority, and external auditors. So the first element that both includes internal and external stakeholders is tax accounting. For example, if you own a business, tax accounting would help you to determine how much tax you owe for the years and ensure you file your tax returns accurately and help you find legal ways to reduce your tax liability through the decisions and credits. Generally, understanding these three types of accounting information that includes financial information management information and tax accounting is essential for making informed decisions. And whether you are an investor, a manager, or business owners, each type of this information serve a unique purpose and audience provide the vital information that helps drive the business success. In the next part of our journey for these sessions, we want to focus on accounting systems. And accounting systems is essential for any organizations, and it's much more than just keeping track of numbers. And we need to focus first on definitions. And accounting systems is consist of personal procedures, technology, and recording that used by the organization to develop accounting informations and to communicate this information to decision makers. If we want to break down these definitions, it's include four important aspects. First, personals, as you can see here, the first element. These are the people involved in the accounting process. They can be accountants, bookkeepers, financial analysts, and other staff members who manage and process the financial data. For example, think of the accounting team is a company that handle everything from the recording transactions to preparing financial statements. The next elements of these definitions is procedures. These are the methods and process follows that follow to collect, record, classify, and summarize financial data. For example, procedures includes the steps taken to ensure accurate invoicing, payroll processing, and compliance with financial regulations. The next element is technology that includes the software and hardware used to process and store financial data. For example, accounting software like QuickBooks or SAP helps automate and streamline financial tax, making the accounting process more efficient and accurate. And finally, we have records. And these are the documents and data files where financial information is stored and organized. For example, records can be digital files or physical documents like invoices, receipts, ledgers, and financial statements that track the company financial activities. But the main purpose of accounting systems is include two important aims. The first aim is develop accounting informations. So we need to develop the informations through the accounting system. This is our first aim. The system gathers and processes financial data into the meaningful informations, and the next one is to communicate information to decision makers. Through the communication of information to decision maker, the system, accounting system, ensure that relevant financial information is available to those who need it, such as managers, investors, regulators, and enabling them to make informed decision. In fact, they need to communicate informations to decision makers and stakeholders that includes internal and external users of financial informations. Generally, an accounting system is the backbone of any organization financial operations, and it integrates people, process, technology, and records to produce the share accurate financial informations and ensuring that everyone from the manager to investors can make well informed decisions. Now we are going to dive into the important aspect of accounting, the information systems. And let's use this visual aid to understand how an information system supports various decision makers with crucial financial informations. As you can see, it includes information user from the left first elements. The next is financial information provided. And finally, we have decision supported. The information users, as you can see, includes the internal and external stakeholders, investors. They need the financial data to evaluate the profitability and potential growth of the business. The next one are creditors, that lenders, creditor are lenders like banks and financial institutions require financial information to assess the creditworthiness of business before expanding loans. Manager also need financial information because they use accounting information to make strategic decisions and manage daily operations. Owners are the next stakeholders, that they are business owners need to understand the financial health of their company and make informed decision about the futures. Customers are the next users of financial information, and they are sometimes customers look at financial stabilities to ensure that longevity of their suppliers and the service providers. Employees are the information users as well, because the financial informations can impact the job security, compensation, and benefits. And finally, we have regulators, government agencies like at SEC, IRS, and FTC require detailed financial reports to ensure compliance with law and regulations. In fact, the regulators, information users are need this information to ensure the compliance in terms of regulations of business. Okay, next part are financial information provided. Profitability, informations of how much profit the company is making in financial positions. That includes details on the company's assets, liabilities, and equities at the given point in times. And finally, we have cash inflow, that includes insight into the cash generated and used by the company over a period. That is very important for assessing liquidity and financial health. And finally, in the final column, we have decision supported. That includes performance evaluations, analyzing how well the company is doing financially. A stock investment, that includes deciding whether to buy, hold, or sell company shares. Tax strategies that includes planning to minimize tax liability and ensure compliance. Labor relations that includes making decision about wage, hiring, and labor negotiations. Resource allocation that is deciding how to allocate resources effectively within the company. Lending decisions that is determining whether to extend credit or loans based on the financial health. And finally, we have borrowing that we need to make informed decisions about taking on new debt. So in the information systems, as you can see, we have informations users. Next is financial information provided that come from financial information systems, and this information supported these decisions that take place generally by these decision makers or information users. Generally, an accounting information system is important as it connects various users with the financial information. They need to make informed decisions, and it shows that investors, creditors, managers, and also other stakeholders have access to accurate and timely financial data, and supporting a wide range of decisions from the performance evaluation to tax strategies. Okay, basic functions of accounting system. This is the next subjects that we want to analyze it in these lectures. And we will be explore the basic functions of an accounting systems. And these functions are essential for ensuring that financial transaction is accurate, organized, and useful for decision makers. If we want to break it down into three functions, we arrive to three important functions: interpret and record business transactions, classify similar transactions into useful reports, and finally summarize and communicate information to decision makers. In fact, in the first basic functions, interpretations is the first functions of accounting system that is to interpret business transactions, and this involves understanding the nature of each transaction and determining the financial impacts. So recording have a special roles in interpretations. Once interpreted, the transaction are recorded in the accounting records, and this steps is crucial because it ensures that every financial event is documented accurately and chronologically. For example, when a company makes a sales or incurs an expense, these transactions are recorded in general ledgers. Next important function is classify similar transaction into useful reports. In classification, the second functions is to classify similar transactions into the categories. This involves organizing transactions into accounts such as revenue, expense, assets, and liabilities. So organize or classifications of assets, revenue, expense, and other accounts take place in classifications parts. And useful reports is the result of these classifications. In fact, by classify transaction, the accounting system can generate useful reports like the income statements, balance sheet, and cash flow statements. And these reports provide a clear pictures of the company financial status and performance over time. For instance, all sales transactions are classified under revenues, while all purchases transactions are classified under the expenses. And the third functions of accounting system is summarize and communicate information to decision makers. Summarization is the third functions that is to summarize the classify data into concise and meaningful financial statements. In fact, summarizing helps in considering large volume of transaction data into the comprehensible formats, and communications take place here in the final steps, and it's a final parts that summarize information is communicated to decision makers, and this includes internal stakeholders like managers and employees, as well as external stakeholders like investors, creditors, and regulators. And effective communication ensure that these stakeholders have the necessary information to make informed decisions. For example, the income statement summarizes revenue and expenses to show the company's profitability, which is vital for investors. Generally, understanding these basic functions of accounting system is fundamental to grasping how financial information is processed and used. And by interpreting and recording transactions, classifying them into useful reports, and summarizing and communicating the information, accounting systems play a crucial role in the financial health and decision-making process of any organization. Now, giving deep into the components of internal controls. Internal control are essential for ensuring the integrity of financial and accounting information and provide promoting accountability and preventing frauds. And let's break down it to the five main components of internal controls. First is control environment. In fact, the control environment is a set of tones of organizations influencing the control consciousness of its peoples, and its a foundation for all other components of internal controls that's providing discipline and a structure. The key elements for control environment is include the integrity, ethical values, and the competence of entities, peoples, and managers' philosophy and operating styles, the way management assigns authorities and responsibility, and the direction provided by the board of directors. For example, a company with a strong control environment will have the clear policies, a code of ethics, and an organizational structure that support the accountability and transparency. The next component is the risk assessment. The risk assessment involves identifying and analyzing relevant risk to achieving the entity's objectives, forming a basis for determining how the risk should be managed, and the key elements is includes evaluating how risk might impact the business and deciding on the appropriate actions to address this risk. For example, a company regularly conduct a risk assessment to identify potential threats such as changing market conditions or regulatory requirements and develop strategies to mitigate this risk. Component number three is control activities. Control activities are the actions generally established through the policies and procedures that help ensure management's directives to mitigate risk to the achievement of objectives that are carried on. And the key elements for control activities is includes approval, authorization, verification, reconciliation, reviews of operating performance, security of assets, and segregations of duties. For example, implementing checks and balance such as requiring two signatures on law transactions to prevent unauthorized activities and ensure accuracy in financial reportings is examples of control activities. The component number four is information and communications. In fact, information and communications involve the identification, captures, and exchange of information in the form of time frames and enable people to carry out their responsibilities. The key elements is includes internal and external communications, ensuring that relevant information is available to the right people at the right time. For example, a company uses an integrated accounting software system that allows real-time sharing of financial data among departments, facilitate efficient decision making and reporting. And final components is monitoring, where we monitor the process that is used to assess the quality of internal control performance over time, and this ensure that controls continue to operate effectively. The key elements for these components include regular management and supervisory activities, as well as separate evaluations like internal audits. For example, regular internal audits and reviews of financial transactions help detect any discrepancy or weaknesses in the internal control systems and allowing for timely corrective actions. Generally, understanding the components of internal control is crucial for maintaining effective governance and ensuring the accuracy and reliability of financial reporting. And by establishing a strong control environment and conducting through the risk assessments, implementing robust control activities, ensuring effective information and communication, and consistently monitoring controls, organization can safeguard their assets and enhance their operation efficiency. Okay, in the next part, we want to focus on the external users of accounting informations. In fact, how understanding who uses these informations, accounting information, I mean, and why it's crucial for grasping the full impact of accounting on business and societies is very important to know about the accounting basics and your understandings. So the accounting users of the accounting information users includes owners as the first external users of accounting informations, and owners are individual or entities that own a company, ranging from the sole proprietors to shareholders of corporations. They need for informations, so they use accounting information to assess the profitability and financial health of the business and make decisions about the future investments and also evaluate the return on their investments. For example, shareholders review financial statements to decide whether to buy, hold, or sell their stocks. The next external users of accounting informations are creditors. Creditors includes banks, financial institutions, and other lenders who provide funds for business. They need information because they use accounting information to evaluate the creditworthiness of the business and determining the likelihood of repayment and set credit terms. For example, bank analyze financial ratios and cash flow statements before approving loans to ensure the business can meet its obligations. Potential investors are the next external users of financial informations, and they are individual or entities considering investing in the business. They seek details financial data to assess the risk and potential returns of an investment. For example, venture capitalists review business plans and financial forecasts to decide whether to invest in a startup or not. Labor unions is the next external users of accounting informations, and the labor unions are organizations that represent workers in negotiations with employees. They need for informations because they need to negotiate wage, benefits, and working conditions. For example, during the contract negotiation, a labor union might review a company's profitability to argue for higher wage or better benefits. Government agencies is number 5 external users of accounting informations. In fact, governmental agencies include tax authorities, regulatory bodies, and other public institutions. They need information for tax assessments, regulatory compliance, and economic activities. Suppliers are the next users of accounting informations. They supply business that provide goods or services to other businesses. They use accounting information to evaluate the financial stability and their customers and ensure timely payments. For example, a supplier checks a company's credit reports and financial statements before extending credit terms for large orders. Customers are individual or business that purchase goods and services. They might be interested in the financial health of their suppliers to ensure consistent supply and long-term services. For example, a major retailer might review a supplier's financial statements to ensure they can meet future orders. Trade associations is the next external users of accounting informations. Trade associations are organizations funded by businesses that operate in a specific industries. They use accounting information to analyze industry trends, benchmark performance, and advocate for their members. For example, a trade association for manufacturer might compile financial data for its members to reports on industry profitability trends. And finally, we have general publics as a final external users of accounting informations. That includes individuals and entities not directly involved with the business but interested in its activities. And they use accounting information to understand the business economic impact, social responsibilities, and environmental practices. For example, local communications and communities might review the company financial statements to assess economic contribution and commitment to corporate social responsibilities. Generally, external users rely on accurate and timely accounting information to make informed decisions that affect their investments, livelihoods, and transactions with businesses. By providing transparent and reliable financial data, business can build trust and maintain positive relationship with these key stakeholders.